Bitcoin does get much larger and more liquid and the volatility goes down, that actually opens the possibility where people could price things more readily directly in Bitcoin, especially when you're talking about a context where, a continent with 40 currencies, and it can become more of a standard that people use. So I do expect volatility to decrease. And while the downside is it takes away from the explosive return potential over time, I think the upsides outweigh it. But I also think we have much more to go, most likely, before that volatility gets to what we consider low, like gold.
Bitcoin may have started as an obscure experiment in 2009, but the scale of its rise is undeniable. From nothing, it has grown into a $2 trillion asset, yet in the global picture, that's still tiny, just 0.2% of worldwide assets. Gold, by comparison, sits at about $20 trillion, closer to 2%. Lyn Alden points out that the gap shows both perspective and potential. Gold has long served as money, but Bitcoin offers features gold never could: instant global settlement, easy portability, and programmability through digital networks. Gold still holds relevance in industry and as a store of value, but Alden argues that Bitcoin may ultimately be more powerful as money. It can move across borders in minutes, and with second-layer solutions, it can scale far beyond its base capacity. That flexibility makes it suited for the digital era in ways gold cannot match. The bigger picture is that Bitcoin is no longer a niche experiment. It's steadily carving out a role as a monetary asset and could eventually capture more than gold's current 2% share of global assets. As it grows larger and more liquid, its notorious volatility should settle. That shift could make Bitcoin stable enough to price goods and services directly in it, which would be especially valuable in parts of the world where local currencies are weak or unstable. Alden sees this as the natural progression of Bitcoin, evolving from speculative bet to foundational layer of digital value transfer. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
I think more fundamentally what it does is it solves the problem of fast settlements. And so it kind of solves a century and a half problem that humanity's had. So, for all of human history, transactions and settlements were roughly at the same speed. You couldn't really transact any faster than you could move around the world. So transactions happened at the speed of foot and horses and ships. But ever since we invented the telegraph, and specifically when we deployed the telegraph over long distances by the 1860s, we reached kind of this new era where people could communicate around the world at roughly the speed of light and therefore could transact roughly at the speed of light, but we had no fast settlement. So settlement still took the form of literally sending and auditing gold, for example. And so we became reliant for about a century and a half on very centralized ledgers to try to bridge that whole gap between fast transaction speeds and yet still very slow material settlement speeds, any sort of like final delivery. And what is interesting about Bitcoin is that it's basically the invention of fast settlements. It finally allows a value to be sent long distances in a way that's practically irreversible, in a similar way that you'd ship gold and it gets audited and therefore that transaction's done. It's not resting on a centralized ledger's ongoing maintenance. And so that's basically what that problem solves. But then it's up against very large network effects. So it starts in 2009. It's tiny. It's up against the $100 trillion fiat currency system, and so it's slowly growing into that. Right now, even at a $2+ trillion market cap, it seems big, but it's something like 0.2% of global assets. Gold at something like a 20 trillion network size estimated is around 2% of global assets. So I think Bitcoin is going to grow into kind of the role that gold fills to some extent, but then potentially has a avenue to grow further still because it's able to solve things that even gold itself as a money can't solve. So there's certain things obviously gold can do that Bitcoin can't do. You can use it in industry. It has all these kind of practical purposes, but as a money, Bitcoin is in many ways more powerful. It's able to beam around the world in 10 minutes, even faster by using some higher layers. And I think another way of kind of thinking about it is because especially with your audience and in general, anyone who's technologically minded, our first thought is, well, the first technology is going to be the one that gets displaced. It's going to be some later thing that comes and displaces it. And the way that I've kind of conceptualized this is that the really big exception for that is communication protocols. Those so far tend to have a very long life cycle of lasting. So whether it's Ethernet, whether it's simple mail transfer protocol, whether it's TCP/IP, whether it's USB, once these things kind of become dominant in their fields, they tend to one, they update over time. So what displaces USB is the next USB rather than literally a competitor. And two, the complexity and the fast moving parts, that tends to happen at the periphery or on higher layers, whereas the core of the system itself is kind of very simple. And I think that Bitcoin is kind of following a similar approach, which is this new communication protocol that exists. And in this case, it's a communication of value, and it's achieved basically network effect dominance. So it becomes increasingly less likely that something within its own field will displace it in a similar way that Ethernet and USB and others have kind of achieved dominance. And therefore, it's going to grow into whatever total addressable market it has, which I think is north of gold's current 2% of global assets.
Back in 2014, Pierre Rochard floated the idea of a speculative attack on fiat money, borrowing dollars, buying Bitcoin, and repeating the cycle. What sounded extreme at the time has slowly become reality. Lyn Alden notes that companies like Metaplanet in Japan are now openly running this strategy, treating fiat debt as a tool to stack more Bitcoin. It's a high-conviction bet that fiat weakens while Bitcoin appreciates. The problem, Alden explains, is leverage. When the market overheats, those who've borrowed aggressively are the first to get wiped out. We've already seen this play out with various altcoin treasury companies that tried to mimic the Bitcoin corporate playbook. The issue is structural. Most altcoins have one or two big rallies, then bleed against Bitcoin over the long run. Bitcoin's network effect, security, and liquidity keep compounding, while altcoins fade. That's why borrowing heavily to load up on them usually ends in collapse. Still, Alden doesn't dismiss everything outside Bitcoin. Stablecoins, for example, clearly have staying power. They fill a demand for dollar-denominated liquidity and payments in the crypto ecosystem. But strip away stablecoins and the rails that support them, and most of what's left is speculation stacked on speculation, lacking Bitcoin's durability. Let's get back to the interview.
So I think it makes sense for someone to do it. I mentioned before that basically in this current system where you have debasing currency, anytime someone can borrow or short fiat currency and go long another asset, as long as they manage risk and volatility well, they get rewarded for it. So I think it makes sense that someone figured that out. You can do it with Bitcoin. It was actually written about by Pierre Rochard back in 2014. He wrote an article called Speculative Attack, and he's like, someone's going to figure out that if you can borrow fiat currency and buy Bitcoin, you're just going to keep doing it over and over and over again. That started happening 6 years later in 2020, and it's been happening ever since. And we're starting to see it in other companies as well. So Metaplanet of Japan, a bunch of others. I think that makes sense. I do think that, this cycle will hit a degree of froth in it. And so some of these levered entities will get shaken out. We've also seen, altcoin treasury companies spinning up, which I think, looking back years from now, will probably not be seen as very positive things to have done to, use leverage to kind of stick altcoins in a publicly traded vehicle.
Just because they're going to wipe out value? Why would we look back and say bad idea?
Because it wipes out value. Yeah. I think basically there's been a long history of, altcoins have one or two good cycles under their belt. When they come out, they get launched, they get hype, but then they kind of roll over relative to Bitcoin and then never really recover. So that's been kind of the case over and over and over again. And I kind of expect that to keep happening just because of that communication network effect aspect that I talked about before. I think Bitcoin has met that standard. I don't really view others as having met that standard. I think they're more like penny stock tech plays, basically, where for example, I'm on the record of being bullish on stablecoins. So obviously, any sort of rails that enable stablecoins to function have some degree of value. So I think it's not to say that there's no value in the space, but generally speaking, it's inflated because there is this really big speculation element and this PvP element kind of built on top of it. And And so I think over time you've kind of seen the narratives play out. And now the narratives in that whole space are pretty weak outside of stablecoins and certain other forms of tokenization.
Do you use debt to buy Bitcoin?
I do not, but I mean, I've been long MicroStrategy since 2020. I viewed it, I treat it as a much smaller position than core Bitcoin. And then anyone who has optional leverage that doesn't get rid of it is in some ways using leverage to buy assets. So, for example, I have purposefully I have mortgages attached to properties because if I can short fiat currency at 3% for the long term, I figured instead of selling stocks or selling Bitcoin to pay that off, I'm kind of indirectly slightly levered on assets. But for the most part, I let other proxies do it for me. I let MicroStrategy do that for me rather than myself hold Bitcoin in debt. Yeah, so my approach is when I'm very high convicted bullish on something, I size it so that if I'm right, I materially benefit from it. But if I'm wrong, it's not like a financial kill shot. It's just a major setback. And so with Bitcoin, it is my largest individual asset, but it's one of many assets. And there's also a difference between someone who, say sticks half their net worth in Bitcoin versus someone who bought some Bitcoin and then because of superior performance, it's become half of their net worth. And they psychologically treat it somewhat different. So I have a lot of Bitcoin exposure, but it's in that kind of broader mindset of more broadly that I want to own multiple types of high quality assets, short fiat currency where I can, or let other, let my assets do it for me on their balance sheets. And I think that, to quote Paul Tudor Jones, I think Bitcoin is the fastest horse in the race. But I don't think it's the only horse. And I think that I have a clearer head by not being 100% in on something. It gives me kind of a Zen aspect in bear markets. So, for example, in November 2022, when Bitcoin had collapsed from 69,000 all the way down to like 16,000, I was at the Pacific Bitcoin conference, and we were having a good time. We were on stage, we were laughing. The energy there was high, and I think because one, people knew what they own, and two, anyone who wasn't levered or didn't size it inappropriately relative to their volatility and risk expectations, use it as a buying opportunity. So I think it makes sense for someone to be all in, but not necessarily everybody, and not even necessarily most people, is how I put it. Another way of kind of pointing out is that Michael Saylor does have other assets in his personal life. He does have properties and things like that. And this particular vehicle obviously represents the vast majority of his net worth. But he'd still be okay if Bitcoin had a problem. So I think people, you want to put yourself in a position where, if Bitcoin doesn't perform the way you think you will, it could be, obviously very damaging to someone financially, but it's not necessarily an irrecoverable thing. If they encounter an issue. And it's going to partially depend on their level of conviction and their level of research that they've done on it.
What began as a niche experiment has quietly grown into a contender for global financial relevance. The numbers alone make the point clear: trillions in value, expanding liquidity, and increasing acceptance among both institutions and individuals. Yet what makes Bitcoin distinct isn't just its size, it's the design. Portability across borders, instant settlement, and adaptability in digital systems position it for uses that traditional stores of value cannot match. That advantage becomes more striking when viewed against fragile national currencies or debt-laden governments, where trust is scarce and alternatives are sought. Over time, as infrastructure matures and volatility eases, the possibility of Bitcoin functioning not only as an investment but as a practical monetary standard becomes harder to dismiss. Will this shift mark the stage where Bitcoin grows beyond its role as a speculative trade and begins to challenge gold's long-standing dominance as the backbone of financial security? So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.